really be interested to hear what is your current outlook for global liquidity. What are you seeing?
Well, I think the outlook is sort of fair to middling, but it's certainly not as bullish as it was, this time last year. I think unambiguously, in January 2024, the outlook looked to be pretty good at a time when there was actually quite widespread pessimism among many advisors. And so it was a relatively straightforward call. It obviously never is a straightforward call, but it was a relatively straightforward call to say that markets were likely underpriced and they'd go up. And that was true generally across risk assets, including the sort of celebrated crypto and Bitcoin. So a lot of those assets did look, undervalued against liquidity a year ago. That's not really true today. And what they're really dependent on is greater momentum from liquidity. And that momentum doesn't really seem to be coming through, and it's not coming through from the US. Partly because you've got uncertainty over the funding program when the new administration comes in, and a lot of the juice, if you like, in liquidity in the US last year was really because of the funding change, where Janet Yellen managed to skew US Treasury funding very much towards the short end. Now, I know that's a sort of fairly wonkish idea, but it did actually add significant liquidity in the US markets. And allied to that, the Federal Reserve was doing what we sort of somewhat flippantly call not QE, which was adding liquidity despite the fact its headline policy was actually a QT policy, quantitative tightening, but they were actually adding liquidity, and they managed to add substantially last year, maybe as much as about $1 trillion US, basically, secretively or in a hidden easing. So those factors are really beginning to wane. Now, if you want to illustrate that process, which I think is an important thing to kick off with, if you take a look at a slide that I've got, which is actually well into the presentation, about slide 17, it shows the chart there, which is looking at our calibration or our measure of what we call not QE. So in other words, the hidden quantitative easing, and also the not yield curve control, which is the hidden easing coming from the Treasury when they're doing a yield curve control, not really fessing up to it. And basically what that illustrates is that there's an impetus in US markets last year of upwards of about $6 trillion, or very close to that, of actually additional, or let's say hidden stimulus. And that was, one of the main reasons that the S&P went up 25% last year, and why crypto was good, etc., why gold went up. All these features are really, phenomena of more monetary liquidity. What you're seeing lately is a fairly sharp decline in that stimulus. That impetus has come right down to under $1 trillion, and it looks like it's fading very fast as we head into deeper into 2025. So that's one thing I think one's got to be pretty cognizant of. I mean, the other thing that you've got in the background is basically what's going on in China. And the situation in China just isn't good. And that comes back to debt. It comes back to debt, and I suppose as well, the US dollar. And that combination is really proving a poisonous cocktail for the Chinese economy. And, just to sort of refresh kind of what's happening there, we know that China's got a huge debt burden, and the economy is really struggling under the weight of that debt. The only way you get out of debt, and particularly debt deflation, which is what China is suffering right now, is to create an offsetting monetary inflation. Now, if you create a monetary inflation, by definition, you're going to destroy the value of your paper money. In other words, you're thinking about currency devaluation. And China is really insistent on maintaining as close a parity to the US dollar as it can. So it's trying to hold the yuan cross against the US dollar as near as damn it on about 7.3 yuan to the US dollar. And that's proving extremely difficult exercise. Now, in order to do that, what they're doing is they're tightening monetary conditions. And that tightening of monetary conditions is basically causing both the Chinese economy to slow down, and we would suspect as well, in looking at sort of upcoming data, it will be showing a decline in the world economy. And if you want to look at that, there's a slide, again, a little bit deeper in the presentation, around slide 11, which is showing that correspondence between PBOC, People's Bank of China, liquidity injections, or actually, as we speak, liquidity withdrawals, and the tempo of the world economy as gauged by a nowcast, a daily nowcast that we put together. And the correlation between those two series is pretty decent, with the Chinese liquidity leading by about 3 months. So if you look at that chart, the omens are clearly not very good for what's going on. So basically, the strong dollar against the background of debt in China is causing China to withdraw liquidity. And then that comes on top of this declining impetus that we're seeing in the US. So generally, the outlook is, as I say, not great